I'm not sure that we're going to necessarily repeat the historical paradigm that we've seen. And so the question is there some sort of planned reset?
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault. My name is Shane Moran, and I'll be your host for this week's episode. And I'm not in the vault again today. I'm in Dubai. It's amazing. Everything gold in Dubai here. And from the entire Live from the Vault team worldwide, we want to thank you for your continued support. And as you can imagine, the community keeps growing more and more every single week. And there's a lot to talk about during these historic times. And Andrew Maguire is in the house with an industry expert by popular demand, the one and only Dave Kranzler, no stranger to the Live from the Vault team. And here we go. We're going to be talking gold with Dave. It's going to be really exciting. You're not going to want to miss this. It's going to be an amazing episode. Nobody wants to miss these episodes. And Live from the Vault, why is that? Because we give you access to information and updates that you just can't get anywhere else. And this episode is no exception. So just before we go to Talking Gold with Andrew Maguire and our special guest, Dave Kranzler, please help us keep spreading the word about this channel by hitting the like button, by sharing it, by hitting that subscribe button. And you can also, don't forget, click on that bell if you want to be notified in real time as each episode goes live. So let me introduce our special guest. For those that haven't met Dave, Dave Kranzler is no stranger to Live from the Vault, and he's a hedge fund manager, a precious metals analyst, and the author of a bi-weekly subscription newsletter called The Mining Stock Journal. And so after years of trading expertise he's built up on Wall Street, Dave now co-manages a Denver-based precious metals and mining stock investment fund to help people understand the truth about our financial system and economy. And with that, let's head over to the UK and Talking Gold with the one and only Andrew Maguire and our special guest, Dave Kranzler. Over to you, Andy.
It is, obviously, this is a major good day for me. Perfect timing. Look at what's going on in the markets. Who do we have here? Dave Kranzler. Thank you, Dave, for joining us today. It's a very, very important day, I think.
Thanks for having me back on again. I don't know if it's a good thing or a bad thing that I'm on.
I say it's a good thing.
Hopefully I won't jinx what's going on.
You know what? It's nice. I think, us subscribers get a lot of information from our side of the pond. The wholesale markets, one thing. Obviously we look at the COMEX too, but you bring a wealth of experience and information. Really, it's all about pieces of the jigsaw, and it's about education. I know you're about education. You have a service that provides education on multiple subjects, including the miners, etc., which we tend to lack on. And so I was wondering if can we start with the miners, because I know that I had a lot of questions. And I said, don't worry, I'll get Dave to come back and we'll talk about the miners a little bit. What are you seeing after this? Literally, I just figure we had an entire third quarter of heavy action, strong dollar, and the inverse correlated selling gold and silver versus every tick of the dollar. So, what are you seeing as far as the miners are concerned?
I mean, the miners, with the sell-off in the stock market really since the beginning of the year, and it intensified this spring. And clearly, it was all what was going on in gold and silver was driven by the paper market, right? The hedge funds were shorting stock futures, shorting silver because silver is supposed to be correlated with the stock market, because everyone knows it's an industrial metal. And same thing with gold futures, shorting those and going along the dollar, and also presumably shorting the euro and the yen against that. So for me, the price that we're observing, and this has been my thesis for quite some time. I mean, it's a dual market, right? It's a physical market and a paper market, paper derivatives market, that operate out of London and New York. Plus the OTC derivatives that, I mean, that's the most opaque market. I mean, we have no idea what those contracts look like. I'll bet you Jamie Dimon couldn't tell you what the contracts look like that JP Morgan has underwritten and is exposed to. So, for me, what's been going on in the paper market is completely divergent from what I'm seeing and what you're seeing and a lot of other people are seeing in the physical market. In fact, Reuters just put out an article yesterday or maybe the day before, and it talked about how there's low vault supplies from the bullion banks in London that supply the Eastern Hemisphere, and they've been diverting bullion from India, which is now going through its most active buying period of the year seasonally, and diverting that to China and Turkey. Turkey's been the largest central bank buyer of gold this year, remarkably. So, clearly something's got to give here. And it feels to me, and as you kind of referenced, there's excitement going on right now. It kind of feels to me like we may be reaching a tradable bottom, even with the manipulation that goes on in the paper market. And, the mining stocks specifically, especially last week, completely outperformed the broad stock indices, even when the broad indices were, even like last week, even when the S&P 500 was getting hammered on Thursday and Friday, the mining stocks were up. So I think that, it could be, and it's been a rough period, really since August of 2020 when we peaked after the March 2020 bottom and all that QE was dumped in. It's been a rough go of it, and the mining stocks, I really didn't think we would see the Amex Gold Bug Index, which is affectionately known as the Huey, or the Hooey, as Craig Hemke likes to call it. I didn't think it would go back below 200, but I think earlier, within the last month or month and a half, I think it got down to like, I want to say 170, but and that's when I started. Actually, less than it was actually last week. It closed at 175, and now it's back up, over 200, and it hit 210 yesterday. So part of that is in correlation with what happened in the stock market Monday and Tuesday, and I think part of it is. I just think we're going to start to see capital that gets diverted into, and whether it's the paper version of gold and silver or not, it still is going to end up putting more pressure on the physical market. And I think we're going to start seeing capital gravitate towards the precious metal sector as a flight to safety, similar to what we saw in the fall of 2008, if you recall. If you look at the charts, they're remarkably similar. The dollar shot up all summer long as the financial markets were melting down. Gold got just annihilated between March and October. Gold and silver. Silver worse. And out of nowhere, gold and silver bottomed in late October and started moving higher. A week later, the mining stocks started moving higher, and GDX more than doubled in the last 2 months of 2008. Now, I'm not saying that we're going to see that pattern repeat again identically, but it sure feels very similar.
Yeah, and it's funny, you just said, you just used the number 2008. And literally, I've just done an episode, and we did exactly the same thing. We were looking at how close this was, and although it might be slightly different reasons, we had the Bank of England last Monday coming out and turning on the QE fire hose. And as if that's not going to affect Europe, the US, every other market, all interconnected, of course. So bearing in mind that in 2008, in June 2008, I think it was, the Bank of England was the first to turn QE on. And then we saw the explosion across the globe. I think gold was about $640 or whatever, it's $630 or whatever it was back in 2008 at that point. And then we saw an almost exponential rise as this QE fire hose started to really depreciate currencies versus paid for gold and silver.
That's right. You know, I don't. I mean, obviously, the Bank of England turned the spigot on last week. I don't know if the Fed's playing a pretty good game of poker here. If it really intends to follow through with what it's saying it's going to do, and you know, maybe part of that's going to depend on what happens with Credit Suisse. Or, I mean, Credit Suisse isn't the only European or U.S. bank that is capable of blowing up at any moment. So, and quite honestly, I would not be surprised if the central banks are addressing Credit Suisse out of our sight. I have to imagine they learned their lesson the first time around in 2008. I do think there will be some blow-ups that come out of left field that they won't have foreseen and won't have been able to monetize ahead of time. And I mean, that could happen this year. I mean, to me, what's most remarkable is the fact that you've seen these just massive moves in dollar contra currencies like the yen, the pound, the euro. And you know, a massive move in the dollar index, massive moves in oil and other energy products, and yet we haven't really heard of any big hedge fund or bank blowups. And you know that there's a massive amount of derivatives that are wrapped around, you know, all of those trades and all of those securities, and that magnify the volatility and the risk of it. So. I have to believe that there's clandestine monetization of blowups going on before they hit, you know, before the public becomes aware of them.
Yeah, and of course, emerging market issues. I mean, UK is now a bloody emerging market too.
We all are now.
I think so. I think the last time that I talk to people all the time, and the last time they say, yeah, look at the dollar, you know, yeah, gold's volatile. Hang on a minute, no, it isn't. You pull up a chart from and you can go back as far as you want, but even if you go shorter term, in the last time the dollar index went over 110, went to 114. That's 20 odd. It's slightly almost 21 year highs, but let's say 20 to 21 year highs. But gold was $315 then. It was $250 pounds in gold. I mean, so you suddenly realize, yes, there's a sort of friction there. There's a coordination, but look at there is a dislocation too. And I think people often think, well, dollar's going up, I have to sell gold, I have to sell silver, I'm a hedge fund manager. And of course it's this herd of hedge fund managers that are the problem. They just don't get the divergence that you just talked about between the paper and the physical market, and they one-to-one sell. We see it all the time, selling, you know, gold futures, silver futures, tick for tick against any rise in the dollar. It's amazing. But I guess the question I was going to come up with there is, do you think there has to be a coordinated effort to devalue the dollar? The Plaza Accord was back in the 80s. That's the last time I think I can remember where the dollar was devalued on a base. What do you think, Dave? Is that possible? Or?
That's a good question. The only, I mean, I would think maybe at some point, although I have to believe that the U.S. deep state actually is okay with what's going on with the dollar because it reaffirms its status as the reserve currency, right? And obviously that's under serious threat from Russia and China. So,
yeah.
I think that the problem with thinking that it's guaranteed that there's going to be, another Plaza Accord or, some type of coordinated devaluation of the dollar to try and put international trade on a more equal footing, is I think everyone kind of thinks the paradigms that we've seen since, well, really, I guess since the Fed was founded in 2013. I mean, 1913, not 2013. I think everyone thinks those same paradigms are going to repeat, which means we're going to have central bank driven, credit driven boom and bust periods, right? Because that's basically what we've seen. I mean, the boom and bust periods have all been driven by, really, the dollar wasn't even wasn't 100% gold backed by the time the Fed was founded in 1913, and it certainly was more de-backed by gold when FDR outlawed public ownership of gold in this country. So I'm not sure that we're going to necessarily repeat the historical paradigm that we've seen. And so the question is there some sort of planned reset? Which, yeah, it'll devalue the dollar. It'll basically take the dollar out of existence. So for the most part, so I don't know. It's hard to say. I mean, clearly the central banks are backed into a corner. It's death by massive depression or death by hyperinflation. So that's why I kind of think all these theories, rumors, conspiracies about a grand reset being put in, starting to unfold. There could be some truth to that. I don't know.
Yeah, and I think it's interesting because I think back we're talking about the 80s, we're talking a whole different situation there, because now we have, and especially when we relate gold and silver to what's going on with the other crosses that comprise the price, ultimately the price. And I think we didn't have a physical market then at all. It was just purely paper to paper. There was no Basel III, NSFR standards for gold. Silver was absolutely cash settled at all times. It was, you got the ETFs in place to flywheel any kind of delivery concerns. You just didn't deliver. You just created shorts. And I think it's interesting because we sometimes forget, and we get sort of wrapped up in our own world of which is day to day, and yet on the other side the physical exchanges are increasingly sucking liquidity out of the paper markets as people wake up to the fact, and look, we've ignored NATO Russia's NATO redlining in March, and what happened? Now they're ignoring Russia's red line warning of nuclear war. I know that people on this side of the continent, every single German client I know is buying every ounce of gold they can. It is so tight for supply. Asian buyers, Indian buyers, all buying gold and silver, very large in silver too. Why? Because they know that anything tangible into this high risk fiat world, you just need to nail it down. And really we're restricted by the amount of physical at this price in both gold and silver that is even put on offer, because there's so little that wants to be put on offer at this price. And so therefore we're seeing these premiums rise and rise and rise. And I think you must see it your side of the world too.
Yeah, I don't like to look at what's going on in the retail physical market with dealers, because I think to some extent, people blame the high premiums on the dealers, which is BS. It's not how the industry works. They're not making that $30 spread on a Silver Eagle. It's really kind of at the wholesale level where I think the big markup's coming. But clearly those premiums are there because there's a lot more demand at the retail level for physical metal than there is supply. But I think that's intentional. I think when the physical supply of gold and silver get tight at the wholesale and institutional level, I think the banks, put the mints on allocation or cut them off completely. And I think that's part of what's going on. Yeah, certainly it's the fact that people are still willing to pay the big premiums at the retail level tells you, similar to what you're seeing in Germany, people are trying to accumulate physical metal here. But what I think, to me, what's going on that is very interesting to watch is what the bank positioning is doing on the COMEX. Because I think it was, I don't know, June or July that the COMEX banks went net long paper silver, right? And so that net long meaning their gross long position exceeds their gross short position. That doesn't happen very often, but it just kept getting bigger and bigger in terms of their net long. And of course, the hedge funds were taking the other side. However, the hedge funds also, and this is even more rare than when it happens in silver, the hedge funds went net short paper gold. Then they covered it up, I think, in August maybe, during that market rally that we had, the overall market. And now they're net short paper gold again, and a lot more net short. And on the other side of that, the hedgers and the banks are aggressively covering their net short position, and it's happening every week now. And also the open interest in paper gold on the COMEX is starting to bleed off quite a bit, which, as you point out, the physical market, that's an example of the physical market draining liquidity from the paper markets. And I think what's going on there is I don't think the banks are necessarily making a speculative bet per se in gold and silver. I think they make money trading gold and silver contracts no matter what, and the hedge funds are easy marks. I think they're worried about, at some point being called on their short position in the derivatives market, the paper market. So that's why I think they're battening down the hatches on their exposure, at least on the COMEX, their exposure to being short.
Yeah, and while they tick for tick, and we've noticed the footprints just like you, tick for tick, where we see, and ultimately when you see, say, correlated, these, obviously these HFTs are designed to lead the neutral algos by the nose, and they know exactly how to move the hedge fund managers from like the herd from pillar to post. And so as we see tick for tick, the dollar rising and these short sell orders coming into the market, I think what people forget is that's a naked short position. It is backed by a long dollar position, but as you say, on the other side of that trade is the house, and the house will win in this situation. Always win it's a casino, right? So they're going to win 95% of the time. As any good casino will have a 95% win ratio, and they'll leave you 5% on the side. But I think people forget that this is actually while the house can cover this game that goes on in this siloed world where you've got the oxygen pumping in, nobody's looking at the real price, nobody's even looking at it, because as I had to get rid of all my clients in 2013, all my US clients, because they were banned from trading over-the-counter markets. So therefore, you're now forced and siloed into this world of the casino, where you can't even, whereas as we know, the market makers have a foot in both camps. So they can trade in both markets. And I think what a lot of people miss is, yes, they can cover against one-to-one against, they're taking the long side one-to-one against each naked short sell on the COMEX, but on the other side, this leveraged market, on the other side, the unleveraged physical market is actually being affected by this because it's still driving the price lower. Regardless, this game of leverage is driving the price lower, which is driving huge demand in gold in every other currency. Certainly in every other currency as the dollar's rising. I mean, pound gold hit March 2020, March 2000. I mean, we had March highs in gold being sold off in the 2000s in dollars. Well, pound gold hit that last Monday. It's pulled back a little, and we tend to forget that, yes, while this game's going on in the casino, there's a real world out there, and the over-the-counter markets are 10 times as large. And as you say, no one knows what the hell is really going on there. And when I met with Andrew Bailey, the head of the Bank of England, when he was the head of the FCA, he said, well, none of us know. It's an unregulated market. How would any of us know? So really, what we can definitely see is that while this game is going on there, the real physical market, as you say, is draining the liquidity out of the paper market slowly, which has to raise the price, because in every other currency, everyone's racing into physical. And it's physical. It's not a paper game. It's physical.
Yeah, I mean, it's interesting. A lot of people kind of live on the edge of their seat on the COMEX numbers on a daily basis. And I stopped tracking it on a daily basis a while ago because I'm not sure how much I trust the accuracy of those reports, given that it's the banks who put them together, right? And if the banks are reporting this part of their business honestly and ethically, it's the only part of their business they're reporting honestly and ethically. What are the odds of that? But I do think it can, it generally, what they have to report some semblance of the underlying trends on what's going on with the open interest and the positioning in the futures and what's going on with the warehouse stock, right? What's in the vaults. And so, a lot of people were kind of watching the bleed off in the registered designated accounts in the vaults, right? And the registered numbers have been coming down all year. And I'm like, no, you gotta watch the total amount, because that eligible is there's a very real fractional nature to that eligible. And a lot of times if you're taking delivery on the COMEX and you're leaving your metal in the vaults, you don't know if you're getting, you might get a warehouse receipt, but so what? Those are easy to replicate electronically, right? So you don't know if you're getting, a bar that someone else has a claim on, or if you're actually getting your own bar. So what I said is I want to start to see the actual total amount of gold and silver leave the COMEX, right? And see the total numbers come down. And we're starting to see that. At the beginning of 2022, in the gold vaults, there was 19 million ounces in the registered category and 39 million in the gold. And now, as of yesterday, there's 13 million, so 6 million ounces of gold have been moved out of the registered, but 13 million ounces have been moved out of the COMEX completely. So someone wanted that gold. And then similarly with silver, and again, I think the numbers that I can only recall off the top of my head, I have a spreadsheet that goes back to the beginning of the year on gold, but the numbers I can recall off the top of my head was that I think early in the summer this year, there was 70 million ounces in the registered for silver, and I want to say 334 million ounces total. And now it's down to 41 million ounces in the silver and 312 million ounces in total silver reported in the COMEX vault. So, you're starting to see, is this the onset of Gresham's law?
It certainly is. And I think this is why we and much like I'm sure you do, the opaque world of the gold market is far, far more opaque than the easier to read footprints of the much smaller silver market. And because it's such a small world, we know very much who most of the players are. And so we can tend to track that. And it's really interesting because we saw this exit of paper market liquidity, which is kind of what we're talking about here. And for example, in the last Live from the Vault we did, which was back on the 21st of September, and what we said was we're trying to draw attention to public attention to the fact that there's such an easy arbitrage opportunity here where you literally take a silver contract, a futures contract, you buy it, immediately sell it into the over-the-counter market in London, and obviously you have to be an insider to do that, or an international trader because no US trader is allowed to do that. And so what you've done is you've bought a chip, closed it, squared it, and sold it into this. Now, okay, you're not actually these traders are not. They have no skin in the game other than to close the arbitrage opportunity. So it started off with $1,000 per contract, then it moved down to 700, 600, 500, and within 5 days, after 3 full months of backwardations in silver, within 5 days, these sharks came in and literally closed that arbitrage opportunity down to square, and this. Literally, we're just recording this on the 5th of October, but I just revealed today for the first time that the guys that came in, the crew that came in to buy silver and to close this arbitrage, we call them the Sharks, was a very large Indian outfit. And I wasn't allowed to talk about it until they closed the gap. And they closed that gap in 5 days. And they are now circling, they swam in the back door of the COMEX. These guys had never had any competition before. These guys were saying, well, we don't care what the price of silver is, but look at the spread. This is a bit like the IG9 trade, where these guys didn't care about anything. They don't care if the price of silver goes up or down, but they just wanted to close that gap. So essentially what that did was force the price to higher, because as this paper market liquidity comes out, and yes, short term, you're buying one, you're closing it, and then you're selling the other. So it looks like it's going down, but you're just essentially sucking out liquidity. It's such an interesting, dynamic that we're seeing right now.
Well, I mean, they saw, a manipulated divergence between two markets, and they basically profited by closing it. And it happened quickly. So, I think at some point we're going to see something like that happen between the paper and the physical market. And, to me, that kind of speaks to why maybe the banks are reducing their exposure to the paper short side on the COMEX. And actually, the BIS. I don't know if you've ever interviewed Robert Lamborn, but he makes a career now out of studying the BIS, and he reports every month on the swaps outstanding, the gold swaps outstanding, and that the amount of swaps that they've done are out there now from the BIS have come down dramatically since the beginning of the year, and I exchanged some emails with him, to try and flush out what's going on. And the best that he can conclude is that the BIS, what happens is the way the swaps operate is it leaves the BIS exposed to the short side to unallocated gold in London. And he thinks that the BIS, especially with Basel III kicking in, they don't want to be exposed to unallocated gold bars, which I can't blame them, because there's probably 10 other people exposed to the same bars.
Yes, he does some excellent work.
So, again, another example of, at some point everyone comes at me like, when's the manipulation going to end? I can't deal with this sector anymore because it's manipulated and it's never going to end. And I'm like, at some point, the market's going to force the issue. So, it's just like the market forced the issue on the central banks to start hiking interest rates. Obviously the precious metals world, especially given the opacity of it at the big boy level, it's harder to read than the equity and bond markets. And but you just know at some point there's going to be a dislocation that's going to correct the big dispersion between the paper side and the amount of paper outstanding versus the physical side and the amount of physical that's being demanded for actual delivery as opposed to leaving it in vaults in London and New York.
Yeah, and you just pointed out the bottom line of it, which is, look, the Bank of International Settlements, the central bank of all central banks. Yeah, I must agree. I haven't spoken to Robert Lambo myself, but I do follow his work. He does excellent work on this, and really, it is exactly what we think's been happening too, which is, why would the Bank of International Settlements instill Basel III NSFR standards on all the banks on the over-the-counter markets? Now you now have to have a T+2 hopper here. If you put a long position into that, T+2, you have to have that backed up with physical, should it be drawn out. So if it goes into GLD, it's la la land. It never it's just more paper, and you can short against it, much like SLV you can. But the BIS, in our view, I don't know if you agree with this, but in our view, I don't think a single ounce, a physical ounce, has left their site account for at least 2 or 3 years, if not more. And what they do is just lay that liability onto the agent banks. And then, so really what they're trying to do is call in all this and square all this stuff up. And I think they need to do it before the end of the year. And I think that's why I think this fourth quarter is going to be quite bullish, because, as you say, you've just discussed their footprints. Their footprints are their footprints. Why would they be closing down these swaps and leases? Why would they be calling them back in? Yeah, okay, the physical never left. It just isn't their physical anyway. But that's interesting, because people should look beyond, as you say, beyond this COMEX world, and look at what's going on in situations like that as well. Good attention drawn to that there, Dave.
So, if you want to circle back to the mining stocks.
Yes, please. I do, because this is something I'm going to get told off if I don't let you speak about the miners. Goodness me.
Well, and it's not all bad news with the miners. There's been a handful of stocks that have actually performed really well, starting in the middle of the summer. So back in, I think it was probably June, maybe. There's a company called New Gold, and its stock got battered, which, these mining stocks, unlike tech stocks, which, up until the bubble pop, tech stocks, they could report crappy numbers and the stock would still go up. These mining stocks, they report something that just comes in line with expectations or disappoints a little bit, and they just get annihilated. And then they don't get rewarded for reporting good news. But there was a stock called Gold News that got blown up early in the summer, and I told my subscriber base, look, and it was trading in the 60-cent range, US dollar denominated, and I said, look, I think this thing's going to trade back up to where it was before, it started getting hit on earnings disappointments and some other one-time events that happened at their mine that, it's the mining business. That happens at every mining company, where they have, something that causes a snag in production that's explainable and very correctable, and often is corrected by the next quarter, but the market doesn't want to hear that. They just bash it. So I just said they're going to get this corrected, and I think the stock trades back up to the mid 90-cent area by Christmas. Well, turns out I was wrong. I mean, it hit $1 last week. So
Wow.
I was targeting a 50% rate of return on the shares by the end of from say June to December, mid-December. I mean, and the stock nearly doubled, in a lot less time. So that's an example. Some of these, some other stocks like Anglo Gold and Goldfields, and I can't explain it yet, but those stocks started going up even before the whole sector started rallying last week. And I mean, they've sprinted ahead on a percentage rate of return basis over the last week and a half, the rest of the sector. And I'm not really sure. I mean, they are African-based miners, but they have, global operations. So I'm not really, at first I was thinking, well, maybe it's a newfound appreciation for what's going on in West Africa with gold mining. And there's got to be more to it than that. So, and I think it's smart money coming in and accumulating these companies. Like New Gold, I think, could get taken over, at a premium to where it's trading even now after it's rallied like it has over the summer. So, I think, what people in the audience who are interested in the mining stocks should do is just start looking at long-term charts, and start with a chart that tracks the Amex Gold Bugs Index or the XAU back to, and I take it back to January 2001 because that's kind of where I marked the line of when the secular bull market that we're in began, and and then run the ratio of, say, the S&P 500 versus the Huey or the XAU for that period of time, and you'll see that relative to, and you can do the same thing with treasure. Just take the 10-year bond price and run the same ratio, and you'll see that the mining stocks and really the whole sector, but especially the mining stocks, because the stocks since 2011, the stocks have underperformed gold and silver. And between then and now, that underperformance has gotten wider. So, the mining stocks are, pretty much historically cheap relative to financial assets, stocks and bonds. And then they're also historically cheap, or, close to historically cheap, maybe not quite as cheap as they were at the end of 2000, but relative to the prices of gold and silver. And so to me, and obviously silver is cheap relative to gold, and that's starting to get corrected. But, for my money, if I want to put, don't look for the bottom in the NASDAQ or, whatever. The stock market in general is not even close to bottoming. But if we're right about what's going on and we start to see the precious metals sector diverge positively from the general stock markets, and I think there's a good probability of that happening. I'm not going to obviously guarantee it, but if that happens, there's some, you can create wealth changing gains, lifestyle changing wealth gains, if you pick the right mining stocks right now and just hold them for a while. And don't worry about whether it's the bottom or not. I always tell my subscribers, it's also about capital management. So, if you have a lot of cash looking to go somewhere, don't jump into, a 2 times levered GDX ETF all at once. Don't throw all your money in that. Don't take your favorite newsletter writer and take all your money and put it in the 10-cent stock that they say is going to go to $1. That may or may not happen. But the point is, start wading in. It's kind of like you wade into the ocean, right? At first you think it's cold, and then it starts to feel warmer the further you get in. That's how you got to. Well, I think you should treat any stock market investment like that, but especially this sector, because it's more volatile, partly because of the manipulation than the general stock market. But if you'll be rewarded if this is indeed a tradable bottom and an investable bottom. If you just, wade in and not worry about catching the bottom and just keep adding as the price goes lower, or keep adding as it looks, if it looks like we're, on a sustainable liftoff. So, and I wouldn't worry about bottom ticking the market, because if we're right about this trade, the mining stocks are so undervalued right now that, if you miss the first 10% of a move in your favorite stock, so what? You still have, 90% of that move left between where it is when you jump in it and where it ultimately is destined to go. So, that's the way I'm kind of looking at it right now.
It's such a specialized area. You know what? I'm kind of in awe of what you're saying, because essentially this is like a massive algorithm. You need someone like yourself who has the experience. You know what? Somebody could look at the same thing as you, but you have, when you've got a deep amount of experience, something in your head says it's probably an instinct. It becomes such an algorithm where in your own mind, where it's an instinct that you would know, well, this over this over this. So really, why would people enter this space unless they had good advice? For example, what would your service cost for somebody? How much is that?
I need to raise the prices, and a lot of my longtime subscribers are like, you're offering this too cheap, but it's $20 a month.
No. Well, you see, the thing is, you're talking about potentially wealth changing moments here by picking the right thing. I think people would be really silly to I mean, what's $20? I mean, it's going to get you a Starbucks and a McDonald's, not even probably these days. So certainly not in Switzerland. It's $60, but
I have a feeling that some people don't subscribe because they're like, how can this be any good if it's if it's only $240 a year? I mean, there's other services, and I'm not going to mention any names that $1,500 a year, and it's just like, oh, okay, now it's time to buy Newmont. Okay, now it's time to sell Newmont. I mean, why would you pay for that? Just buy GDX if you want to be told when to buy Newmont.
Well, Dave, I think that's what people should do if people are interested in this space, and I know a lot of people are because we had a lot of questions, a lot of people asking you to come on, and you know what? A lot of these probably haven't paid you $20 to get this information. And I honestly strongly suggest, look, here's an opportunity. We're looking at the gold and silver markets. We're looking at definitely, this is a paper to physical divide. We've never seen it this extended before. So from our side of the picture, we see a huge rally coming back. We see the Bank of International Settlements squaring up their derivative positions. We see even in the nickel market, we see J.P. Morgan removing themselves out of the commodities sector. They don't want to expose to this risk. They're all moving out of the silver sector. This is a bottom coming in, and so really miners to me, and everyone keeps telling me, really miners is where you should be because you're getting a double whammy there. And they're so oversold. So I'm strongly suggesting people, look, it's about wealth preservation, and a lot of what our education is about wealth preservation, but this is about making money. And you're just talking about a stock that was at 60 cents, it went to $1. I mean, say no more. I mean, what's 60 cents, for God's sake? I mean, I don't know what sort of size people can buy at, but do have people come to you and they just buy a few, or do they buy a lot? What is it? Do you have institutional guys?
It just depends on the risk appetite of the specific subscriber and what their how much resources they have to devote towards the sector. So. There's some guys that, and I don't want my subscribers to tell me what their position sizes are. It's none of my business.
No.
Some of them, will buy 100 or 200 shares at a time. And there's others that run 5 and 6 figure position sizes in some of the individual stocks. So it's just, and again, when I present an idea or update a stock that's in my portfolio of ideas, I always say, I point out, look, this is where this stock is on the risk spectrum. So keep that in mind when you're making your investment allocation decisions. So, and I personally, I like to look for the home runs. I'm looking for the stocks that aren't well covered by other newsletters or by Bay Street, Wall Street, Fleet Street, or is it Fleece Street? But so I'm looking. I try to, and it's harder to do because there's a lot more people looking at the sector now than there was 15 years ago. But you can still find ideas. A longtime colleague of mine begged me to look at a particular gold development project, and I was like, yeah, I know, I need to look at it. I've had subscribers asking me about it, and I started looking at it yesterday, and I'm like, holy crap, this thing's 3 or 4 bagger if we go into a bull move. So, that's an example of a stock. And this stock's actually, it's been out there forever, but it got the crap beat out of it over the last year. And now, like all the other great ideas that are sitting there waiting to be had, the low-hanging fruit waiting to be picked, this one's just sitting there. And, I think this, like I said, I think over the next year, this could be a 3 or 4 bagger. If we are at a bottom and start moving higher. So, either way, I think this stock has been beaten up so much it's going to outperform the sector, even if the sector just goes sideways. I think this stock still moves higher.
What I'm hearing here, Dave, is people need some expertise here. It's a minefield out there. You could be I mean, I would not know. I mean, just wouldn't know. I mean, I specialize, and I think if you specialize in any one thing, you become very good at it. But for me to even conceive of, well, which would be it would be like me starting from scratch. I think it's so important that somebody picks an expert, picks somebody. I mean, for that kind of money, I mean, what's to lose? You've got nothing to lose. So, but I was going to ask you one last question. Where do you have any, because we have a lot of silver guys following us, huge amount of silver guys. And Shane is the biggest silver guy I know. Just to please Shane alone, do you have, where do you see silver in this mix as a miner, or as you follow them, or simply where do you see the price? Big question.
I mean, there's a lot to unpack there, actually, but
I know it's a terrible one to finish on.
I'll try and make it succinct. I mean, obviously, in my opinion, silver is dirt cheap relative to gold right now. And you just look at just go to a 20-year chart of the gold silver ratio, right? And it looks like the gold silver ratio is rolling over. And and I haven't run the actual ratio in the last few days, but where it's like 85 or something right now, whatever. It peaked, in the mid 90s. And it bottomed out in 2011. It bottomed out, I think, at like 30, 31. And so I think, again, if this is a bull cycle that we're starting in, I think that the gold silver ratio is going to bottom out lower than where it bottomed in 2011, because all the factors that came together and created what happened in the sector and in the markets back then, they're even more intensified and bigger now. So why we had an extreme move to the downside in the sector. Why aren't we going to get an extreme move to the upside? And if that's the case, I mean, silver's going to sprint laps around gold. Now, that's not to say that you should put all your eggs in the silver basket. I wouldn't do that, because it's more volatile than gold, and you got to have a stronger stomach. And also there's some extremely undervalued gold miners out there. Also, the stock that I'm going to have in my next issue tomorrow is a gold miner. So, and the other issue with silver is there's very few primary silver miners, like that. A majority of what they mine is silver. But there are some junior exploration development companies, and actually Silvercrest Metals. Most of their mineralization, you could call them a true primary silver producer, and they just started producing, and they're ramping up. And I mean, the stock, I picked that stock at 16 cents in early 2016. I had to put it in my short sellers journal as a contra NYSE trade, because I didn't have the mining stock journal yet, but I had to get the idea out there. So I was on record, saying, hey, I flagged this at 16 cents, and it's been as high as 11 or 12 bucks, and it's down to 582, and I freaking missed it when it got down to 5. I was busy doing something, and I'm like kicking myself. But that's a stock that I think, if we're starting to take off, that stock could easily triple or quadruple from its current price now. And they're going to be producing a lot of high-grade silver going forward. So at any rate, I like the usual silver, traditional silver stock names. A lot of them are now producing, a majority of what they produce is gold, like Coeur d'Alene or Hecla. Fortuna Silver, and it's another extraordinarily undervalued stock right now. But I think to get the real benefit of what's going to happen in silver, you need to find the silver, I call them development, micro-cap venture capital companies, the ones that have a project that they're advancing and they're still in the early stages, and the market cap, might be 10 million, it might be 30 million, but if they're successful at flushing out an economic deposit, I mean, you're looking at 10 baggers. And if silver does what we think it could do, some of these stocks are, they're going to completely change your lifestyle if you have enough shares. And you don't need to make, you don't need to put 50% of your investable wealth in that. I mean, you could, if you got a couple ideas that you think are going to be, grand slam home runs, throw 10% in there in both stocks or whatever. And, you're going to make more money than you ever thought was possible, even versus chasing the .com stocks.
That sounds an awful lot of work there, Dave. And I would get people to employ you to do it for them, because you could probably spend every hour of your waking day and night trying to filter through this stuff. I think my bottom line that I'm trying to say is you've got to go to an expert like Dave here, and just, if you're going to invest in an area, you need some guidance. You need someone who knows, instinctively what to look at, what not to look at. You probably eliminate 9/10 of it before you even get to what you would like to really look at in detail. So I would strongly suggest people do find you. We will put the link in, Dave, and for your great service. And I certainly am going to sign up, because it's interesting. I want to learn more about it myself. And, as if I haven't got enough time in my hands anyway, but I know. But again, that's the whole point. I don't have the time, and so therefore, I will definitely do that. So I'm going to strongly suggest everyone does that. I do thank you for sharing so much of your precious time today, Dave, and please, come back again. We'd like to have you on a regular basis and to update us on all these things. But thank you.
Sure, anytime. Thanks for having me back on again. It's always educational for me just to listen to you, especially with what's going on in the London market.
Well, thanks, and see you again soon.
All right. Thank you, Andrew Maguire and David Kranzler. It's always amazing to have you on this episode, on another episode. Thank you so much for that fascinating discussion. And remember, everyone, buy physical and understand the difference between what Andy affectionately calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled. And there you have it. That's all we have for you today on another episode of Live from the Vault. Please help keep spreading the word about this channel by hitting the like button. Share this information with everyone you know, and make sure you are subscribed. If you want to be notified in real time as each episode goes live, just hit that bell, and there you have it. So with that, we'll see you next time on Live from the Vault. See you then.